Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HubSpot.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps the channel grow.
So today is Thursday, February 12, 2026, and we have quite the situation to unpack.
We really do. I mean, if you're just looking at the headlines or checking your portfolio app, you might be scratching your head a little bit right now.
Right.
We are talking about HubSpot, ticker HUBS. They just dropped their fourth quarter earnings report for 2025.
Exactly. And usually, earnings season is pretty straightforward. You beat the numbers, stock goes up, you miss it goes down. But today,
not at all.
We're looking at something completely different.
Yeah, it's a total head scratcher. So let's just set the scene. HubSpot releases their numbers. By almost every metric, they crushed it, beat expectations.
Absolutely.
And yet, what happens when the market opens? The stock price just takes a nosedive. It dropped nearly 10% in regular trading.
It's a classic disconnect, and honestly, it's one of the most interesting setups for an investor because it forces you to ask, is the market wrong? Or, are we missing something invisible here?
Right.
That gap between the business performance and how the market reacts, that's often where the real opportunity is hiding.
Exactly. So let's play detective here. I want to start with the actual numbers because I feel like we need a baseline of reality before we get into all the market psychology.
Good idea.
Walk us through the top line. Was the business actually good?
Business was excellent. I mean, if you just look at the revenue reality, there is no sign of a slowdown. For the fourth quarter of 2025, HubSpot brought in $847 million.
Okay, $847 million.
That is up 20% year over year. Now, think about that context. For a company of this scale, hitting 20% growth.
It's difficult.
20% growth at that size is nothing to sneeze at. And that puts their full year revenue for 2025 at what, $3.13 billion?
Yep, a 19% increase for the full year. But I want to double click on something here. We often see software companies grow just by raising prices on their existing customers. That's not real growth, right? That's just squeezing the lemon.
That's the first thing I look for. It's the difference between pricing power and volume growth. And honestly, this is the most bullish part of the report. They are not just hiking prices. Their total customer count grew 16%. They're at nearly 289,000 customers now.
That is a massive number of new logos. It means they're actually winning market share, not just exploiting their current users.
It is. And here's the kicker. The average subscription revenue per customer also went up.
Oh, interesting.
It rose 3% to just over $11,600. So they're adding customers at a double-digit clip, and those customers are spending more.
That tells you the product is sticky. It's not a nice to have, it's a need to have.
And that's reflected in the subscription revenue number specifically. That grew 21%.
And I always look at that because, service revenue is one-off. It's consulting, onboarding, things that don't repeat. The subscription revenue is the engine.
That 21% is the heartbeat of the company. It tells you customers are locking into the platform. But we need to talk profitability.
Right. Because for years, the knock on companies like HubSpot was they just burned cash to get that growth, the growth at all costs era.
Yeah, spending $2 to make one. But looking at these margins, that era is dead and buried.
So what are we seeing?
Management has executed this massive pivot toward efficiency. Operating profit for the quarter surged 44%. to $191 million.
44%.
And that represents a 23% operating margin. To give you some context, that is up 4 full percentage points from last year.
4 points. That's a huge leap in operating leverage. It basically means for every new dollar of sales, they're keeping way more of it as profit.
Precisely. They've managed to decouple their expense growth from their revenue growth. They're not just throwing bodies at problems anymore. There's serious discipline there.
So, okay. Revenue beats. Customer count is growing. Profits are up 44%. And the market sells the stock off by almost 10%. It feels like we're in the twilight zone.
It does feel that way.
Yeah.
But we have to look at the financial health and how they're allocating capital to really understand the foundation here.
Okay.
Because while the stock price is, wobbling, the balance sheet is what I call a fortress balance sheet.
I love that term. What makes it a fortress?
Cash. Lots of it. HubSpot is sitting on $1.8 billion in cash. And critically, they have no significant debt.
Which in this interest rate environment is a huge advantage.
It's the ultimate insurance policy, and it's also an offensive weapon. Which brings us to the capital allocation news.
Right. They didn't just let that cash sit there. They announced something pretty significant that caught my eye.
A $1 billion share repurchase program.
Okay, now let's pause here. Because often, when a high-growth tech company buys back stock, investors get nervous. They think, don't you have better ideas? Why aren't you investing in R&D?
Right.
Why is this buyback different?
Context is everything. Look at the timing. The stock has taken a beating along with the rest of the software sector. By authorizing a $1 billion buyback now, the board is sending a very loud signal.
They're saying the market has it wrong.
Exactly. We know our intrinsic value, and we think the stock is cheap. It's opportunistic. It's the ultimate vote of confidence.
It's like they're buying their own dollar bills for 80 cents.
And remember, they generated $595 million in free cash flow for the full year. They can fund this buyback entirely from cash flow. They don't even need to dip into their reserves.
So they can fund their growth and buy back their own stock. That's a powerful position. But before we move to strategy, did they give any clues about 2026? Maybe the stock dropped because guidance was terrible.
Not at all. The guidance was solid. For Q1 2026, they're projecting around $862 million, and for the full year, about $3.7 billion.
So that implies, what, 18% growth?
18% growth.
Yeah.
On top of the numbers they just put up.
That does not sound like a disaster to me.
It's not. It's very consistent. But we'll get into why the market might have shrugged at that later. First, I think we need to talk about how they're going to get that growth.
Right, because they're not just a CRM tool anymore.
Exactly.
Yeah.
This is the part that gets really interesting. They're using this new terminology, the agentic customer platform.
Agentic. It sounds like something out of a sci-fi movie. What does that actually mean for a business?
So this is the competitive moat they are digging. For years, a CRM was basically a fancy filing cabinet. You put customer data in and you looked at it later. It was passive.
Right. It was a database. You had to do all the work.
Exactly. The agentic shift means moving from passive data storage to active AI agents.
Sure.
It's about the AI taking action.
So instead of me searching for a customer and reminding myself to email them, the software does what?
The software, using tools like their Breeze agents and Smart CRM, coordinates the work. It might notice a customer is stuck on your pricing page, draft an email based on their history, and then flag a sales rep to call them.
It's like hiring a digital assistant for every single employee.
That's the vision. And this is crucial because of the acquisitions they've made. They aren't just building this from scratch. They are buying the best tech out there.
We saw them pick up companies like Clearbit and Cashflow. How do those fit in?
Perfectly. Clearbit is huge for data intelligence, knowing everything about a lead. Cashflow helps with billing. By integrating these, they're building this unified platform.
And that makes it harder to leave, right? If HubSpot is running my data, my AI agents, and my billing, I'm not switching anytime soon.
Exactly. High switching costs. That is the definition of a moat. And this tech is letting them make a very specific move, the upmarket move.
Explain that. HubSpot used to be the tool for small businesses, right?
Historically, yes. That was their bread and butter. But with these new AI capabilities, they're targeting scaling companies, mid-sized, large enterprises. They're going head-to-head with Salesforce now.
That's a heavy hitter to take on. Salesforce is the Goliath in that room.
It is. But HubSpot has an edge in this economy. Total cost of ownership. They're generally cheaper and easier to use than the legacy players. And in a tight economy.
CFOs love hearing cheaper and easier.
You got it. Which brings us back to the elephant in the room. If the strategy is sound, financials are solid, they're buying back stock, why did the stock drop almost 10%?
Yeah. What gives?
We have to zoom out. This drop wasn't really about HubSpot. It was about the neighborhood they live in.
The software neighborhood.
Exactly. We saw sector-wide weakness. If you look at the IGV, which is the big ETF that tracks software stocks, it's been having a really rough time.
What's spooking software investors?
Two things, really. AI disruption and tariff concerns. But the big one is this growing fear that AI is going to replace human workers. And if AI replaces humans...
You need fewer seats or licenses for software?
That's the fear. The logic is, if one AI agent can do the job of 5 sales reps, I cancel 5 HubSpot subscriptions.
So investors are just selling the entire sector first and asking questions later?
Precisely. But here is the disconnect. If that AI is killing software narrative, we're true for HubSpot right now. Wouldn't we see it in their forward-looking numbers?
You absolutely would.
And this is where the calculated billings metric comes in.
I always hear analysts talk about billings. Why is that more important than revenue sometimes?
Because revenue is the rear-view mirror. It's what you earn today. Billings is the windshield. It's what you invoiced for the future. It predicts where revenue's going.
Okay, so what did their billings do?
In Q4, HubSpot's billings jumped 27% to almost $972 million.
Whoa, wait. Revenue grew 20%, but billings grew 27%.
Yes, that is a massive signal. It means the business is actually accelerating.
So while investors are selling the stock because they think the business will shrink due to AI, the actual invoices show that business is speeding up.
That is the disconnect in a nutshell. The narrative in the market is AI kills software. The reality in HubSpot's numbers is AI is helping us sell more software.
That's a fascinating opportunity. But I have to play devil's advocate. We can't just paint a rosy picture. What's the bear case? What could go wrong?
It's important to look at the risks. The biggest one is macro. Even if HubSpot is great, if the whole software sector crashes, and we're seeing the worst streak for the IGV since 2020, HubSpot will get dragged down with it.
Right. When the tide goes out, all the boats lower. It's like being the best house in a bad neighborhood.
Exactly. And there's also the perception of their guidance. Remember the 18% growth for 2026?
Which sounded good to me.
It is good. But for some high-growth investors, they wanted a massive beat. They wanted management to promise like 25%. By just giving inline guidance, some traders got disappointed.
The curse of high expectations.
And finally, that AI disruption threat. It is a valid long-term risk. If the entire economy shifts to autonomous agents, does the per-seat pricing model survive?
That's the existential dread part. They have to transition to charging for outcomes, not just logins.
Right. And that transition is hard. It's messy. If they fumble that, the bears could be right. But for now, they seem to be the ones building the agents, not being replaced by them.
Okay, so looking ahead, next 3 months. What should investors be writing on their calendar?
First one is obvious. Q1 earnings. Early May 2026. We need to watch that revenue target of $862 million. If they hit or beat that, it proves the acceleration is real.
And product stuff?
Yep. Keep an eye out for industry conferences. They'll be revealing updates on Breeze and their AI agents. If they show something that really wows people, that could change the whole narrative overnight.
It changes from AI replaces HubSpot to HubSpot is the best way to use AI.
That's the goal. And finally, just watch interest rates. If the market suddenly decides software is safe again, we could see a massive rotation back in. And HubSpot, being so beaten down, would likely snap back harder than most.
It's like a coiled spring. The fundamentals are pushing up, sentiment is pushing down. As soon as that sentiment lifts.
The spring releases. That's the setup.
All right. We've looked at the numbers, strategy, risks, the market madness. Time for the verdict. How are you scoring HubSpot right now?
I am giving this a bullish score of 8 out of 10.
8 out of 10. That's pretty high given the sentiment. Walk us through the final thesis.
It comes down to asymmetry. You have strong revenue beat, this massive shift in profitability, a clear AI strategy, and 19% free cash flow margins. That's elite.
And the downside seems protected.
By that $1.8 billion in cash in the buyback program, yes. The floor feels solid, and the ceiling is high because of the valuation disconnect. Some DCF models suggest the stock could be up to 55% undervalued at these levels.
55%. So it could almost double and just be at fair value.
Theoretically. Now, models are just models, but it shows how much pessimism is priced in. My view is this is a multi-year hold. You buy it, ignore the noise, and look up in 2027.
So this is a build wealth over the next 2 years investment, not a get-rich-by-Friday trade.
Exactly. You're buying a high-quality asset while it's on sale because other people are panicked about a theoretical future.
It reminds me of that classic advice. Be greedy when others are fearful.
And the market is certainly fearful of software right now. HubSpot is giving you a very good reason to be greedy.
So what's the takeaway? I think it's about psychology. The market is panicking about AI replacing software, but in that panic, they've created a discount on the very company that is successfully using AI to grow.
That's the irony. The thing everyone is afraid of is the thing HubSpot is mastering.
A classic case of the narrative separating from the numbers. And usually when that happens, the numbers eventually win.
They almost always do. The narrative is volatile. Cash flow is reality.
Cash flow is reality. I like that. Well, there you have it, a deep dive into the disconnect at HubSpot, a company making money, growing fast, and getting punished for it, which might just be the opportunity you're looking for.
Just remember to do your own research. Check the risks, look at your own portfolio. We're here to guide you, but it's your portfolio.
Absolutely. Risk management is job number 1. That's the summary for HubSpot. We'll see you in the next one.